Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Hello, and welcome to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman, and it is currently Thursday, February 13th at just about 4 p.m. And this is Investment Friday for February 14th, Valentine's Day, if you are in the US. Actually, I don't know if Valentine's Day is celebrated much outside of the US. So if you're a listener that is outside the US, comment and tell me if you celebrate Valentine's Day, because I was literally thinking about that just the other day. I am here solo for today. Brad is getting ready for a cruise. So he will be on a cruise all next week. So I will be solo next week as well while he is out on the ocean, not working or trading or recording podcasts. So we'll wish him well. He has a wonderful vacation and holiday out in on a cruise ship. I personally haven't been on a cruise since I got married in 2006, in June of 2006, and we were on an island hopping cruise going around Hawaii. And my husband and I got married on the island of Kauai. And the next day, I think it was the next day, he started not feeling good. And then we had about 40 people on our cruise that came with our family and friends and whatnot. And about half of our group came down with a nasty norovirus. It was terrible. I didn't get it somehow, but my husband did. And so it was not a good 2 to 3 days actually of the trip where a lot of people were really feeling bad. So anyway, I haven't been on a cruise since then. Um, and that's not the way that I would normally travel, but some people love it. So anyway, there's that story. In the market update side of things, we are, as of Thursday at 4 p.m. here, the markets are up quite a bit for the day. They're up on the week for the most part, even though we had a little bit of a dislocation. We had, gosh, 2 days ago, we had a sharp drop. Even earlier in the week, right? We've just been kind of holding steady up and down. We're experiencing the volatility that Brad and I have been talking about quite a bit, right, over the last couple of months, saying that, hey, we don't know what it's going to look like as the Trump administration starts putting things into place. Are they going to go really fast with stuff? Is it not going to work out? And what I'd love to note is that we are seeing, again, exactly what we were thinking we might see. He's trying to push things through really quickly with executive orders, and the market has been responding to that pretty negatively on different days, right? When we thought the tariffs were going to go through, we saw a really steep drop off. And then when the tariffs did not go through, especially on Canada and Mexico, those two anyway, didn't get implemented as was planned on, we had, a big bounce back in the market from where it had fallen. And that's the volatility. That's literally the volatility we're talking about and the speed that we're talking about, right? So when we are noticing like how quickly there's a lot of news coming out, there's a lot of stuff going out of the White House briefing room, a lot of um, executive orders being put out there. But what's happening, a few days later is we're seeing a lot of pushback. We're seeing lawsuits being filed. We're seeing freezes being put on some of these actions until we can get more information, more clarity, all of that. So it's been interesting from a market perspective to to see the market reacting kind of in real time to what's happening. And that's what the volatility we're experiencing is reflecting for us. And underneath that, we are still expecting, as we've said a few times, modest growth over this year. So last year, we saw big growth in the markets, in the S&P 500 and NASDAQ, Dow Jones, all the big indices were up a lot. We don't see that for this year. We don't expect, 20, 30, 40% gains this year the way that we saw last year because of these different factors that we're looking at and experiencing right now. So we will continue to probably see these seesaws up and downs. Might feel a little sickening, in the moment, especially, if we have market drops and that doesn't feel good. And then 2 days later, we gain it back and then some. That might be our normal for a little bit here. When normally, statistically, January, February, December, January, February are typically good months in the stock market. And so instead, we're really seeing a lot of back and forth right now. With that said, we also were looking at some inflation data and kind of projecting forward from that. We did see higher inflation. Inflation numbers came out this past week that were 0.4% or 40 basis points higher month over month. So over the last month reading. And there's kind of like mixed opinions about what that means. So we are not seeing the inflation from tariffs that we had expected, right? If the tariffs went into place the way that Trump had described them originally, and a couple weeks ago that where they were slated to go on, um, we would see inflation from tariffs there, but we're only seeing moderate inflation from tariffs in the places where they've actually been put on so far, which has not been as widespread. Even so, right, like we're still waiting to hear. So kind of the thing that happened today that caused the market to spike, especially towards the end of the day here, was that Trump came out and did say that they're going to do some review of different tariffs. They're going to look at it instead of saying, okay, these are going on and this is happening, right? So this is a more moderate, more measured response to the tariffs. And what the market took from that was, oh, okay, we're maybe not going to see those tariffs anymore because they had started to price in these higher tariffs, which, as we've talked about, are inflationary for the economy, make it hard on consumers, all those different things. We had priced that in and had, some of these lower, these volatility days on the low side over the last couple of weeks, especially last maybe 4 weeks or so. And now if it's, hey, we're going to talk about it, we're going to have more discussion about the tariffs instead of just, put them on and see what happens. The markets actually took that as a really good sign. And, traders had a big lift on a lot of different stocks. Nvidia being one of them, that which took a big hit a couple of weeks ago when the news about DeepSeek, the Chinese AI large language model (LLM) came out. And we talked about that a couple of weeks ago on the podcast as well, if you want to go back and listen to that one. So NVIDIA had a couple of good things come out that lifted their stock price again, which also then, since they're such a gigantic company at this point, helped lift the S&P 500. And so, yeah, we're seeing some moderate. It's interesting because it's like moderately good news that we're seeing that's lifting the markets quite a bit higher. So they're kind of trading on a pretty high tailwind that, the news isn't that good to maybe to warrant that high of a response, but we will see. With that, that slightly higher inflation data that we saw this month, When we look forward into the future, that was again without any tariffs. So that was just inflation, like core inflation that we were seeing. And what we are now hearing when it comes to interest rates is that maybe, so for this whole entire year, we're only in February right now, maybe for this whole entire year, we might see a 0.25% or 25 basis point rate cut from the Federal Reserve, from the Federal Open Market Committee. And that's a huge change. If you have been listening for a while and you were listening, last summer, last fall, we had been expecting probably another 2% um, overall throughout the year and throughout this year of 2025. And now, because inflation is starting to creep back up again, we're very much not expecting that at all. We do not see anywhere near 2%, not even, again, not even 1% rate cut this year. We're looking at maybe a quarter of a percent, um, because we've got some inflationary things happening at the moment. So when we take all of that into account, what does that start to affect? We're looking at, maybe more moderate equity growth this year, not the sky high equity growth that we saw last year. Again, continuing volatility, which we've talked about quite a bit. Um, Not as much from the rate cut standpoint. So what does that trickle down to? Um, Affects the bond markets, affects the, overall mortgage rates and prime lending rates. And so we are kind of in a holding pattern, just in a real wait and see kind of stage at this moment as we get through, especially this first part of the Trump administration, this first year. So if we come back in December or next January and we've had a moderately okay year, but it's been up and down a lot, and come back to the podcast and be like, hey, we were right. Um, I would love to be wrong on the side of, hey, we have a great growth year. I would love that. Um, Being someone who's going to sell my house and purchase a new one, I would also love it if interest rates came down, right? Because I was just looking the other day, my interest rate is at like 2.49% on my house right now in Cincinnati, Ohio. And so you know, I am in the bucket of humans who like, man, it really does stink to have to give up that low interest rate to, move and make a fairly big change, but to move into possibly have to go into something that's in the 6.8 to 7% mortgage range. So I don't forecast that coming down to that 6.5 or 6% range, unfortunately. Um, but yep, we'll all see what happens over the next, 3 to 6 to 12 months. What I wanted to talk about today, though, so I have been getting some really great questions from clients lately, and I wanted to talk about investing in line with your values. And I know for different people, everyone has their own beliefs about investing, about what it means, about the power of money in our economy. And my take on it as a financial professional, as an investment advisor, is that, money is a huge source of influence and control. And where we put our money, where we spend our money, where we invest our money does have a direct impact on our economy, right? So I have I've believed that for a long time. I've known that, and I just believe I've known that for a long time. And have very often, been very conscious about choosing to work with small business owners, work with local businesses, eat at local, privately owned restaurants, just be really conscious and cognizant about where I'm spending my money. Does it mean I'm perfect about that? Absolutely not. Um, I still, appreciate the convenience of Amazon Prime. I still, um, have lots of places where convenience is important and I need that for my family. And so that doesn't mean I'm expecting perfection from myself or from anyone else, but I do know how important and impactful it is to keep dollars in your local community as much as possible. Um, and with that, one question that I received from a client this week who is moving her money over to, to be invested with me and with Juncture, was, is it possible to align her investments and her portfolio with her deeply held values? Because where it's been for the last, 20 years, it's just invested in the overall market and a diversified portfolio. It's done fine, that no like complaints necessarily about investment performance, but it's become really important to her now that she is able to control her own investments. She's not beholden to anyone else at this point, and she can really choose for herself. She wants to make sure that she's investing in companies that align with her values as much as possible. Again, knowing that perfection isn't going to happen. But if there's a choice that she can make where to invest her dollars, then she wants to be able to make that choice. And she wants to be able to um, define those parameters for her portfolio. So I wanted to talk about that because it's becoming um, much more widely understood just how important it is, and just how much our dollars as individuals, you know, you making one choice, just you, yeah, you're just one person. But if there are more and more and more people who are just one person making that decision to vote with their dollars in different ways, that can affect change. And we can support the companies that we feel are um, doing business in a way that we appreciate and want to see more of. So this has, and I want to define a couple of things first. So we can talk, a lot of people have heard about socially responsible investing, or ESG investing. What do those things even mean? So socially responsible investing is usually considered socially responsible due to the nature of the business that the company conducts. So this is usually going to be looking for companies that have positive social impacts, um, that care about, it could be caring about climate change, it could be caring about the environment, investing back into the communities where they live. Um, those are really big, important parts of socially conscious investing. And then the other form is known as ESG, or environmental, social, and governance. Those are the E, S, and G. That form of investing, or when things are labeled as ESG investments, that is mainly referring to, it's focusing on the company's management practices and whether they tend towards sustainability and community improvement. So it's not necessarily going to be a company that's has, environmentally conscious practices, or, works to combat global warming or anything like that. Like it's more about the management practices of the company itself. So in some ways, we've got these different categories, socially responsible or ESG. We've got these buzzwords floating around, and different fund companies, mutual fund and ETF companies that are trying to put together these portfolios that people can just buy into, that if you are socially conscious or consider yourself, you self-identify as socially conscious, want to take care of the environment, want to support local communities, want to support, you know, growth in other places around the world, um, that you might self-select as someone who wants to invest in an ESG type mutual fund. But that doesn't necessarily give you the same control over your portfolio that you actually want, right? So that doesn't mean that they are, we'll use the current thing that's been happening with DEI, diversity, equity, and inclusion. Companies that are keeping their DEI policies, for example, have seen some very interesting things happening. We've got, between Costco and Target, that was an interesting um, thing that happened this past week, where Costco came out and, against pressure from a lot of different parties, said, no, we are keeping our DEI policies in place. We are not changing any of the way that we do business based on these executive orders that are coming down from the president. And their stock price soared. Like, it's been up consistently for the last week or so. And I can even look it up right this moment. It's up another 1% today. So over the last week, it's up more than 2.5%. And on the other hand, Target came out and immediately said they were, getting rid of their, or changing their DEI policies. Um, and other news has come out beyond that, right? About, like, well, maybe they're just changing some of the language and not getting rid of that completely. But that perception was so strong, right, between those two companies, that it was so strong that they're down over 4.5% this week. Where again, Costco was up over 2.5%. And so we're seeing this have effects in the market. And this has happened over every administration. So I want to stress that this is not to say that um, this only matters in certain political climates. What I truly believe is that this matters in all political climates. And if we can choose, if we can take a step back and look globally, or have like a higher viewpoint of what we're doing with our dollars, right? If it matters to you how the country is run, how a company is run, who's benefiting, if a company has, we'll use Costco again as a great example, partially because I think they do have really solid management practices as well. They pay their employees well. They have very strong benefits for their employees. Um, and from a consumer perspective, they've always been a good value. The products that they bring in are high quality, and they only mark them up a certain amount over wholesale, right? So customers are able to get a good price for all of these different goods. Their employees are being paid well. They treat their customers well. They treat their employees well. And famously, um, the CEO, I think it was a year or two ago, it was fairly hilarious. Um, Someone suggested that in the food court that they needed to increase the price of the hot dog and drink, because you can get a hot dog and like a 24-ounce soda for $1.50, $1.50 for a giant hot dog. And someone's in a board meeting suggested that that was, it's losing money. They shouldn't be selling it for that low. And the CEO, he basically threatened to punch this person in the face if anyone ever tried to raise the cost. of the hot dogs and a soda. And one of the reasons that he cited was that families come into Costco to eat when they don't have enough money to go out to eat anywhere else. And if they can feed their family, say it's a family of five, and they can have hot dogs and soda for, literally $7.50. That's really important because you don't actually have to be a member of Costco to eat at the food court. You can just go in and eat at the food court. Um, and so it's that kind of stuff, right? That kind of social responsibility. The company, the CEO at least, feels a social responsibility to be a net positive in the community that they are in and serving. Be a place where people can come and eat, and not raise the price of the hot dog to 2.50 or $3 or 3.50 or $4, like whatever. Like you could, sure, but he refuses because it's not always about the money that that hot dog and drink could be making. It's about the broader social impact of what that's doing. And I will say also, this is 0% a recommendation to buy or sell. I have to be super clear about that. This is not a recommendation to buy or sell any stock or company that I am talking about today, but I am talking about, the ability to decide and choose where you invest your money and why it might matter, right? So you could be of the mind that the economy does what the economy does, and I just want to be able to, as one individual person, be able to benefit from the growth of the whole economy, and then I'll take care of myself as best as I can, right? That can be your outlook, and that's fine, and that's a lot of people's outlook. Um, and so if you are invested in, index funds that invest in the entire S&P 500 or the entire NASDAQ or the entire Dow Jones, in different ways, then you're going to own pretty much everything, right? If you own SPY or IVV or um, any of the ETFs or mutual funds that track the S&P 500, for example, you're going to have all of those companies in there. You're going to own Target. If you don't agree with the way that Meta and Facebook gather people's data and manipulate people's data and, um, you know, lobby in the government and different, if you don't agree with that, but you own SPY or IVV or any of these other large ETFs or mutual funds, then you own a pretty big chunk of Meta, right? Because that's in those ETFs and mutual funds. And so this is what people have been experiencing. Lots of people have been asking these questions. Like I don't want to benefit from that. I had a question from a client about a month ago asking if we at Juncture invest in private prisons, if we have that in any of our portfolios. And I thought that was a fabulous question, right? So I went to Brad, I asked him, I said, hey, do we have any investments in private prisons in our portfolios? And he said, no, we do not. We do not invest in any private prisons because we do at Juncture a, we try to put a filter of social responsibility on our investment picks from the beginning. And it does not mean we still have precious metals. We still have oil and gas companies. Um, in different types of portfolios, but we do filter out some of those most controversial spaces um, as a first pass. And so I was able to go back to that client and say, no, we don't have any positions in private prisons in our portfolio. But the point is that even if we did, if that person said, I don't want anything to do with that, I don't want that in my portfolio, I don't care how they could go up 1,000%, I want nothing to do with having profit from private prisons in my investment portfolio. And our answer would have been done. Absolutely, like it's sold. The minute that you decide you do not want that in that portfolio, it's gone. Um, But I do appreciate from the front side that we didn't have to say that anyway, because we don't have that in our portfolios. But as we look in this year, as we see a lot of shifting, and we're seeing a lot of companies we're seeing a lot of companies vote with their dollars, if you want to put it that way, right? There is a lot of lobbying going on, a lot of dollars spent, millions and millions and hundreds of millions, probably billions if I look up the number, spent in lobbying from big companies, from health insurance companies, from, Meta, Facebook, Google, um, which is Alphabet, right? Like all of these companies are lobbying Congress to have laws passed that will help them economically, that will lower regulation in lots of different ways, right? And so we're seeing people ask, "Hey, can I put my dollars into places that actually align with my values, that actually feel like they care more about their workers, care more about their impact on their communities? Can I also invest my dollars there?" And when we create portfolios at Juncture, the answer is always yes. That's straight up the answer is yes. So what are we doing with this client where, she's moving her money from somewhere where it's mostly in these large mutual funds that own everything? We're going to put her in to a different portfolio. We're going to choose a stock portfolio that will still meet all of her objectives, all of her financial goals, right? We're going to look to make sure that it's the historical averages of those companies and all the parameters, all the investment parameters that we look at as professionals still meet those objectives of earning, 8 to 10% per year on average over time, not necessarily every single year, right? But on average over the course of the next 10, 20, 30, 40 years. But we're going to do so in a way that's thoughtful, and to do so in a way that says, "Hey, you know what? If you don't approve of a certain company, we'll find a swap." We can do that. It's easily within the realm of possibility where it would not have been necessarily before. It would have been a lot harder 20 years ago to create a portfolio that could still earn, that average 8 to 10% over time and be mindful. It just, the tools weren't as sophisticated. It wasn't as easy to do that. Um, and most investment managers really like didn't do that very well. It was more about, nope, we're going to sell you these mutual funds or sell you these products, and that's how we manage, so that's what we're going to do. And so I want to, again, like, just let people know that you can be in more of the driver's seat with what you're investing in. Um, no matter where you sit on the political spectrum, you can have a say in how you're invested, in getting to invest with your values, um, especially if you have very strong opinions about and feelings about anything in particular. We had a client years ago that really disagreed with the practices of Walmart. Again, this is not any sort of recommendation to buy or sell. Um, just purely anecdotal. She was really had been put in the portfolio, and every time she saw it, she was just not happy. She's like, I thought I would be fine just having it in the portfolio, but it just really bothers me every time I open a statement and I see it there. And what was the answer? Was like, cool, yeah, out. We'll sell it. There are other companies that we can replace that with to fill whatever, that niche, that spot. It doesn't have to be something that is going to, give you that feeling of like, ugh, like it just makes me feel bad every time I see it. We don't have to do that anymore. Um, Another gentleman, didn't was very conservative Christian and didn't want any Disney in his portfolio. Right? He didn't agree with some of the practices of Disney, right? So we can this goes kind of across the board. You can have what you want. You can choose to invest in the way that you want. And if your investment advisor or your financial advisor doesn't work that way, or says it's too difficult, or yeah, I guess we could, but that's, just know that it is possible. It is possible. You do have options. You do have the ability now to work with advisors who will work with you and your preferences so that you can be, again, voting with your dollars and putting your investment dollars where you want it to go. Um, and it can look like what we talk about socially responsible or ESG. Um, if you like those certain portfolios that other people have put together, but it can be even more tailored than that, right? It can be mostly comprised of companies that you understand, that you are invested in both monetarily and that you want to see succeed, right? Let's do it. Let's figure it out. Let's figure out what that is for you so that you can feel like you are part of the solution that you want to be a part of, whatever that is, that you are part of that solution, right? Why does that matter? Well, because if we all get to use our resources, this is part of, what I truly believe in my financial planning practice, right? That my job is to help people learn how to save wisely, spend joyfully, and support the causes that matter the most to them generously. All of those three things, right? Saving wisely, especially saving wisely and supporting generously, those things can be done through investing and investing in the companies that you want to support, right? So if it matters to you to have more, get away from oil and coal production, there are lots of other companies that we can invest in to support that goal, both monetarily, right, and um, receive the benefits of that investment when those companies grow and they return back to you, right? There are just so many examples of that. But if that's not something that you've been able to talk with your investment advisor about, or if it's always just been, here are the mutual funds that we're going to be investing in. These are the ones that are performing the best. So that's what we're using and they fit into our model. And you're done with that and you don't agree with that anymore, just know that there are options available for you. Okay. Um, if you have any questions, if there's anything coming up for you around, is this possible? Am I crazy? I've asked this before, and have gotten, the answer that, yeah, if you want to invest in socially responsible things, then you're going to be giving up all kinds of return. That's not really the case anymore. That was the line a long time ago. That's what investment advisors would tell their clients. And I know this because I asked, um, I think as recently as 2020, that question came up and an older advisor said, yeah, we're not really going to do that because you can't get as good of a return. And that's just not true anymore, is the thing. That's not true anymore. I don't have anything else to say about that. But that line of thinking is still very prevalent, especially in um, the population of advisors who are older, more entrenched in the way of doing things that they, maybe started with, especially, 30 years ago, 40 years ago. If they've been in the industry for a long time, that line of thinking can, again, still be fairly entrenched. Um, so, and I say that having been in the industry for almost 20 years now, right? It's been 18 years that I've been in the financial planning industry, but I think I also came up in the industry when things were in huge flux. Things were big, shifting, changing, right? I started in 2007, and right away, 2008, 2009, crazy stuff happening in the US, right? We had the Great Recession, um, rolling into 2010, 11, like things were changing, things were different starting right when I started in the industry than they had been for the previous 20, 30, 40 years. Um, so that could also be why, someone like me, I've been in here for almost 20 years, but change has just been a way of this industry for the last 20 years. We've been in constant change, and having to be flexible with that and available for that and work with it. That's just the way that things are now. And we deserve, you deserve, as a client, deserve to be listened to, honored, respected in this conversation as well. So whatever that looks like for you, I encourage you to ask questions, ask your advisor what options are available for you, um, and actually like push for what you want. Say what you want and see where that's available. If you have any questions, I am happy to receive them at Hannah, HANNAH, at expansiveceo.com. As always, if you would like to ask any specific question and have me answer it, or have me and Brad answer it next time Brad's on, of course, we love to receive those questions all the time. Yeah, feel free to reach out. So thank you so much for listening. If you're in the US, and it's Valentine's Day, I hope you do something to give yourself a little bit of, some self-love. If nothing else, right? If you have a partner and you can spread a little love to them today, or kids, that's always so beautiful. But even all of us deserve to feel that love for ourselves. So I would encourage you to do something loving for yourself today, or this weekend. So much love to everyone. Have a wonderful, wonderful week ahead. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com, and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.